Good afternoon, everyone. Let's welcome Rakesh Mishra sir to take this session on investments. Sir's career spans decades at the intersection of technology, and he is currently part of Transmeo, the only startup with an industry-ready platform for autonomous fiber sensing AI services for real-time anomaly detection. And he also serves as a founding coach where he's personally guided more than 1,500 founders through the journey from early stage operator to executive leader. He is also the author of Startup Success Engineering Framework and conducts hands-on workshops on product market fit, venture DNA mapping, and investment pitch engineering for leading incubators, enterprises, and institutions. Today, he is here to help us understand what truly makes a startup investment ready. So over to you. Welcome.
Thank you, Nirpam. And before I begin, I actually want to congratulate everybody who is present here, especially the Bharat Innovates 2026. As I was talking to the Sign team some time back, this is actually a very unprecedented opportunity. I don't think in India it has happened before for this scale, this kind of opportunity, the startup being taken to different geographies. And I'm just hoping to just a beginning how in India we are able to really touch the kind of scale, both in terms of finding the startups which are worthy of going to really the global and supporting them whatever it needs. And in that journey, hopefully today I'll be making a small contribution as a part of these things. Just today's topic suggests that it is art and science of fundraising we'll touch upon. It is a complex actually area. I'm sure some of the in audience, some of veteran entrepreneurs or those who are the experienced ones have already gone through some of the cycle and they do understand that this whole entire fundraising is a very complex cycle. It's a complex phenomena. Often, if those who have not raised the funds so far have seen it from only from surface or from other side, hopefully I'll be able to decode some of this. And as I say, from this entire subject matter perspective, there is a science part of it, right? Where you can basically learn methodically, you can prepare yourself, execute entire thing. And always we say it's a democratic knowledge. Everybody, irrespective of you are successful or you're not successful, it's a democratic knowledge. You can understand and you can learn. But then there is a art part of it also, right? You as a founder, your own creativity, your attitude, and your energy. This is actually, these are some of these intangible. Often we discount and not really pay weightage to understand how important it is as a founder, what you do with whether investor or with the customer or with the partners, anybody that plays a very big role. And I've seen where these factors with the same founders, various different lot where with the same level of knowledge and understanding, even then somebody will be winning and somebody will be missing out purely because of this, the art. That so hopefully that art part, some of it will touch, and I will wish all you best to bring the best out of you with the art part to take care of that part. And in the today's session, if you are a first timer, you haven't raised fund ever, and this is the first time you'll be going to do, then basically we will decode and simplify some of these dynamics of the fundraising. Hopefully from my experience of last 10, 15 years working with a lot of founders, have seen the journeys of all kind, a lot of failures, a lot of successes, and whatever I have learned, put them into some of the knowledge bites, and I'll share with you. Those who have experience already might have raised seed round or Series A, pre-Series A. Hopefully, you will find some new interesting perspective. It's the same subject matter, but I have tried to put it in a way where you might have a little bit different perspective to relook at that. If you do have comments, if you do have something different that you think will be valuable for the audience to know, please feel free to share. I would be more like a facilitator here rather than an expert. And if there is a knowledge that you think is valuable for you as in an audience, please bring it out for everybody's benefit, right? So with that thing, we are talking about here investors. So one thing that we want to begin with, let's look at it, understand really the whole this community, the investor community, right? The people you are going to or the funds or the organization you'll be going to for asking for money. Typically, if it is a typical VC or a angel network, they will be receiving anywhere close to 5,000 pitches every year. This is like amount of what the pitches, and this is I would saying probably in the modern context, probably this 5,000 number would have gone to maybe 6,000, 8,000 in that range. It would have gone. That's the amount of pitches that you will see these investors they'll be receiving in a year. Now, out of those, typically there'll be the 500 of them, which is roughly 1/10 you're talking about, which will be more deep dive. So this 5,000 just the pitches. People will come, either they share their pitch decks or they'll make pitches in events like this, something facilitated by incubators, wherever. But 500 is what they might deep dive in a year. So you can look at it pretty much. You are talking about an average in a day or two deep dive or two, three deep dive they will do. And out of this number, you will see probably maybe maximum three conversions which they will do. So is a one single fund out of this much effort, they will be basically funding three startups in a year. Now, this is of course I'm generalizing just to give an idea in terms of the really the whole dynamics in terms of the numbers. Different funds have different sizes, they have different capacities, so numbers may be a little bit here and there, but you get an idea that this is what is happening with investors. 5,000 pitches they see it, 500 they will actually do the deep dive discussion with you in a hope that they might give you a term sheet, and then finally do the deal with the three. And this is what you are going to be up against when you are pitching to anybody. You need to keep that in mind. This is the person or the team sitting on other side is what they are going through as a part of this, right? Now let's take this further. In this dynamics, I just want to get an idea from the audience. What do we think that for us to be able to get, let's say, term sheet or to get the fund closer, how many ultimately pitches that one will have to make? Do we have any guesses from the audience? And please speak, feel free to speak. Just let me know, what do you think, how many pitches as a founder you expect that I'm going to make these many pitches, then after that my fundraising will happen? What is that number?
Sanidhya has written 50 plus.
What else? Other guesses? Yes, somebody's raised hand. Please go ahead.
10, 30, 60 plus.
Wow, what a range. Yeah. Good. So now I can definitely see the range of experiences in the audience, right? So yes.
80 and above, 200 pitches.
Perfect. I'm so happy. At least there are people who are in the level of experience understand. You know, this number I'm talking about is roughly you're saying average 50 plus pitches. And reason why this is important, you know, when I work with especially the early stage startups, a lot of time expectation remains that I'm going to make 4 or 5 pitches and investor should be able to just fund, which is far, far, far from the reality. So as a founder, you're talking about around 50 plus pitches you to make in various forums, whether you're meeting one-on-one or as a part of the platforms, as a part of any other event. But 50, and yes, somebody is quoting number 80 or 90, even that is a part of reality. And I can tell you, some of the good startups who have raised big funds, I have seen their journey where they have probably would have made upwards of maybe 200 pitches. 200 to 250 pitches they would have made, right? To the extent that if you wake them up in the night and then just ask them, they can just make that pitch. It is like so rehearsed, so done because they made so many pitches. But this is the expectation. I mean, you are saying you are going to meet 50 investors at least, after which probably you will get the first offer from you, right? So that is the nature of stamina. That's the nature of confidence. That's the nature of patience that you need to have when you are getting into the fundraising, right? So with that kind of dynamics, in today's entire session, what I'm going to do, so over the years, as I'm working with founders, seen some of them succeed, some of them struggle, some of them fail, various different, it's a very, very diverse landscape of what happens in the funding as an area. It's really, really diverse. What I've done, I have put together what I call is a funding success canvas. Now, what it does, it essentially takes us through the entire gamut to help you understand core financing proposition, because ultimately you're financing your startup. Understand the deal win gates. What are the gates when you win? What gates you got to cross? And I'm going to take you through in terms of very quickly, understand the nature of the success. And then look at the investor's risk map, because that is ultimately what is driving. Everything is related to the perception of the risk what investors are carrying. And we will quickly take a look at that, the investor engagement journey, because that's what you'll go through in the entire lot. And ultimately, we'll also quickly touch base some of the questions which have come in, where we've seen what are the deal breakers and what are the stage mapping. So we'll go through this entire success canvas, hopefully within the time is 1.5 hours is really, really very short time to actually do justice with something like a fundraising. Usually workshops which cover it in detail, you do it probably day long kind of thing. But hopefully I'll be able to pass enough with you so that you are informed enough to do, right? So we'll get started to very first important thing question. We'll look at it. Should you actually raise money? That's the first one, because a lot of time founder they feel that raising the money is just like essential, necessary, one important part of startup. So the question is, do you really should you raise money, right? Now we look at it, which you're going to see actually a lot in my presentations. I'm presenting these concept and experiences as a part of graphs or as a part of, because that makes it easier for us to just quickly conceive the thought and understand that what I'm trying to convey to you. Will see a lot of these graphs. So here you look at it, two axes on which this thought, which I'm sharing with you, is one is your funding ask. Are you asking for small money? Are you asking for big money? So that is your dimension of the funding ask. Second dimension is what is the valuation proof? When I say valuation proof, if you're going to say my startup is valued at $10 million, $20 million, what is that you're backing with? What kind of proof you are carrying, right? And we will see some of these things in more detail to understand really what each of these means. But very high level, if you look at it with these two axes, if I were to look at it, one side that you might have actually no proof, you are early maybe, or you are still in the process where you haven't achieved those goals or milestones. So you might have poor valuation proof, or you might have very strong proof. Similarly, you might have low ask. You might be just doing the pre-seed. You might be asking for 10 lakhs or maybe crore, or you might be looking for a very high ask. You're talking about maybe $5 million, that pre-series or series A kind of range you want to do that. Now, in this spectrum of thing, if you are in the quadrant where your valuation proof is not existing, not much there, and you really don't need big money, don't go out to ask for money. Not required. The best deal, it is not essential that you must raise the money. So if you are in a situation you can manage, you can take care of your financing whichever way. There are a lot of jugaad which you can as an entrepreneur can do to sustain and to manage your finances. But if you can avoid at this stage when you don't have enough valuation proof and your ask is not really much big, just build your venture. Focus upon building your venture. Don't get into the cycle of fundraising, because fundraising as a process takes a lot of time. It takes bandwidth, mental bandwidth as well as physical bandwidth. Do not take that, right? So if you are in this quadrant, don't worry about funding. Figure out your jugaad ways how you can sustain, manage your finances, and continue building your venture at this point of time. If you are in the quadrant where you got very, very strong proof and you have funding ask, usually these are tactical fundings. You actually, because your valuation proof is strong, which means that you are fair enough advanced in terms of your journey. You do have customers or you got revenue, those kind of proofs you do have. And your funding ask is not very high, which also means that you either are able to manage through your revenues, or you already have whatever your initial funding, you have managed your finances well, your cash flow is good enough. So you really don't need big money. So you can look at it tactically. If there is for certain maybe cash flow crunch is there, or a particular deal that you are going to, for which you require money for tactically, you may raise that. But if you can avoid at that stage, you better avoid raising the fund. And reason I'm saying, because often, see, equity, more often people look at fundraising, mostly the equity, what people look at it. And equity is one of the costliest form of financing. It is the costliest. I mean, in a lighter term, I often say, giving away equity is like giving your blood. So if you are a founder, for you, the equity is the most precious part of your entire venture. So tactically, if you need, look at as a team, discuss with your advisors and figure out, do you really need to? If you don't need to sustain at least till series A above, you, if you can manage there, that's a fantastic for you. And some of these things we'll see in future why, as we go progress, we'll see why that is important, right? And if you happen to be in a quadrant where you don't have enough proof and your money requirement is very high, so that is this very high friction zone. Here it is something where you are not able to support your valuation, or not able to support the proof of that you got evidence of your progress, but your money requirement is high, which could be because it's a capital intensive business, or it could be that money that you had it, you already burnt and you still need to continue the operation that you have taken for that thing. So it becomes high friction with the investors. And what it means that for you, it is a risk, because if the terms or the lesser dilutions, those things, if you miss, next rounds are going to be extremely challenging for you at that stage, right? So you have to be very, very careful navigating this particular quadrant. And you happen to be in this quadrant, then more, this is what we look at is like a strategic quadrant. You have very got a strong valuation proof, and you have reasonably high ask. And high ask is there because the reasons, and some of them we will dive into as we move forward. There are reasons why you need that high funding. So it is a strategic thing. So this placement basically will give you idea, should you raise or should you not raise? And if you are raising, what should be your approach, thinking about how you are basically raising money, right? And if you move to next issue with that, which is about how much to raise. I mean, once you know that I'm going to raise that thing, the next question comes, how much? And often that is the one area where I've seen the whole range. People having an idea as much as possible, raise as much as you can. Some of them not having really clarity that whether this funds will meet my requirement or not, that kind of thing, right? So fundamental principles when you how you want to look at it, quantum amount of fund that you want to raise. Usually I divide into three different consideration, three different segment here, or you put ABC kind of thing, right? You need to have very clear idea what is the minimum funds required for, let's say, non-aggressive business plan. So when I'm saying non-aggressive business plan, essentially your confidence level to meet your projections and look at the risk involved in terms of the market dynamics, that is moderate for you. You have reasonable good confidence that this kind of, and this is not, I'm not talking about a low risk, very because that kind of business plan often is not very attractive and it's not very promising. So you're still talking about a reasonably good business plan, but not very aggressive business plan. Your aspirational plan, which is separate. So this is what calling A, where essentially you're talking about minimum funds required for me to execute my business plan. Whatever you're saying for next 3 years, you need. Usually, because most of the startup here are going to be, I think, early stage. So when you raise any funds, whether seed round or pre-series, those kind of thing, usual time frame for which the fund deployment you'll need it is going to be 18 months to 2 years. This is what mostly happens unless you have the nature where it is like a huge capital deployment. You just finish off everything in 6 months. Some of those are exceptional scenarios which need to be dealt really carefully. But that is what the minimum funds where you look at how much money to raise. Now, even in that segment, when we are saying minimum funds, so some of the things which are important when we are assessing that money, these are against certain goals and milestones, and we'll see what we are talking about quickly. But they have to be, funds are not just a basic guesswork. It is based upon your business plan to give you understanding that, okay, this is how I'm looking at my business to unfold. And to run this kind of a business, this much money I can manage either through whatever your own contribution or other contributions which are available. Plus, this much could be from the revenues. Whatever is the gap that you have, which you cannot fulfill, your expenses are higher and you don't have that much cash flow money available, that is the gap becomes your necessity for your fund. And that is the gap in a cash flow projection. When you do it for over maybe 18 months or 2 years kind of time frame, you realize that how much is the total quantum or total gap of money in terms of cash flow that I will need to make my business plan come true, which is essential, right? And every penny that you draw from that money which you need to be there, somewhere there is an impact in terms of your business plan. So either you're going to have lesser number of customer, lesser deployment, or lesser amount of, or the lesser quality of the solution. Something is there that will impact it if you don't have that kind of money being available, right? And here, the capital that you are raising, expectation from investor will be that you're talking about here efficient capital deployment. That's a very important factor. Uh, Efficient capital deployment means here the way money has to be spent, the value that has to be generated that from that money, that is what investors care about a lot. They say every dollar, every penny that you're going to spend, what is the value do you create? That is what they will care about. So your capital deployment, when you're doing your entire cash flow projection, expense planning, and I'll give you one in a lightweight terms just to understand aspect of that. Sometime when I've seen the cash flow planning and seen their expense estimation, the salaries which are allocated to the founders, you just take a look at that and you look at as if it's like it's a dream job. You get there and you are getting the top of the line salary in there. At this stage, when you are staying, investors do not expect you to really look at it, the large part of your burn happening, which is not creating value, which is just going sustaining the life of the startup. That is not what the best way to look at it. So you have to, this is one of the ways where when they look at the efficient capital deployment, they make sure that some of these things part of the negotiation they'll discuss with you. So you have to be careful. What is it the money that you are spending in some of those activities which may not be necessarily generating huge value for the company? And you need to be also aware of the cost of these external funds. So when I'm talking about cost, which means at what cost, what you are raising, it is coming to you. And this cost is not necessarily in the monetary terms. For example, dilution of your equity is a very important aspect. You look at it that this is what the cost, essentially the part of your company giving away for raising this fund. So more you're going to raise, more the equity you're going to let go, or more risk you're going to take as a part of that. So that is the piece you need to be aware. And you need to be having some sense that, let's say, even if you're planning 12 months or you're planning 18 months, you need to really know that how much runway that you'll need actually to sustain the operation. So based upon the business plan, if it comes through, how much can you sustain without really materially harming unless you will raise the next round. So let's say, as of now, if you are raising, let's say, seed round. That gives you maybe a 12 months of run. Now, next, if you are looking at right after the 12 months, your cash flow becomes zero. You don't have any money in your bank balance. You need to at least plan 4 to 6 months as the runway to be able to raise the next round. Raising the same kind of a round again, actually, that is not what you will expect. So if you raise, let's say, maybe $500,000, $1 million now, and after 1 year, when you're done with the round, what you expect that you would have created better value, and next round you are looking at that will be at a multiplied value. So today, if you are valued at, let's say, $10 million, you expect that after a year at least you should be going at least double valuation. You should try to get to that part so that your next round you do not let out the equity. Otherwise, same as basically with the current valuation, letting out all of your dilution which is happening in future as part of that, right? So you need to take care of that runway planning, that I am going to raise this fund. It is going to last me 12 months. And if I'm going to be needing money, either your cash flow need to support you to have that breathing space for that 6 months, or you need to take that 6 months into account as a part of your expense when you are calculating your funding requirement as a part of that, right? So in here, ABC terms, you look at it, your A is basically your minimum that you require your non-aggressive plan. Now, if you believe that with the extra money available, you can actually, there is a better opportunity and you can follow an aggressive plan. And when I'm saying aggressive, aggressiveness is more in terms of either you're talking about amount of sales or amount of your the GTM, the way you're looking at it, or you can look at it in terms of expansion, or you can look at it in terms of really the number of users. So any dimension that represents that you can become more aggressive in terms of taking the growth. If that opportunity market is offering to you, it is not something which you take as a forced approach. If it is naturally coming to you because market is really looking good, like in modern terms, you'll see all the robotics, AI, all of these things are really, really hot topics, right? So if you got in proposition, if you have something good, market probably is willing to lap it up and they will be able to offer you good proposition. So if you can expand fast, then you look at this extra buffer. You look at this B part portion of your funding requirement. You're saying, if I get this much extra, so this is the minimum. If I get this much extra, actually I can have a much, much more aggressive. I can go into the market, right? And then you are putting the C as the buffer. We are saying, look, this much I require for my runway, 6 months, whatever that much I needed. So this is how when you do calculation, you basically put A, B, C, this kind of number, and then you look at what is the appetite that investor will have. Where if you think the investor is willing to support you in terms of the aggressive plan, you can present that picture. Or otherwise, you're talking about basically going with your not so aggressive plan, but look at A plus C kind of a model to do that, right? So that takes care of the thought, how much really we can go and raise as a startup, depending upon the stage you are in. Now, from there, we look at it. What is it that with these funds you will do? So money you're raising, there is a purpose to it, right? So here, if you look at some of the example I'm giving, depending upon what stage you might be, when investors are going to ask you or put the money, they will be interested to know what this money is going to do for you. Part of that money, you may want to showcase that I want to move where I'm at a MVP level, minimum viable product I have ready, and now I want to do my first pilot or couple of pilots I want to execute. So the money I'm going to receive, basically I'll be able to take from MVP to couple of the pilots. That is what is purpose of my fundraising, right? That is one milestone. You could look at it. You could look at it similarly if you are at a pilot stage to say, I want to get into more repeatable revenue things. So it is like a little bit bringing stability into your cash flow, stability into your market reach. So you're moving from pilot stage to having an early revenue, that kind of stage, right? So you're moving the stage. Similarly, if you are a little advanced stage startup, you will talk more in terms of really the growth path change, the trajectory change. You'll say, with this money coming in, today I'm sitting at a $1 million ARR kind of run rate of my revenue. And if I get this money within 18 months, I'm able to push this run rate to $5 million. So you are just jumping 5x into in terms of your revenue run rate by getting this. Now, if your revenue run rate comes with a good unit economics and a profitability, what it means that you are able to generate that much cushion of cash flow within your company, and you will be next round, what you'll be raising will actually be much more multiplied value because you already have enough buffer coming in that. But if this money comes in, just to give a hypothetical scenario comparison, so if I'm going to raise $1 million and within a year, I'm creating just $1 million revenue out of these things, where I'm sitting maybe today $500,000, I do not have enough cash flow that I have generated to self-sustain. So right end of this funding round, and when the money gets over, I probably am forced to again raise the next round. where I may not have enough sufficient valuation available for me to protect my dilution. So this milestone of how money will be used and creating the growth for you is extremely important. You may as well look at regions like product validations, one large plant deployment, or it could be for, let's say, for acquiring large capital asset, which is important for you to scale or to bring in the, let's say, productionization of your IP, those kind of things that you can look at it. But what you will need to clearly bring out that money you're going to raise, while what milestones, what is the outcome as a value creation you will do. Now, I think if you would have done the pitch deck, one of the key things that you will typically put as a part of these things to define clearly that this much will go into operation, this much will go into product development, this much will go into marketing, this much will go into other areas, expansion or the sales like that. So while the milestones will tell you what is that I will achieve, the breakup of funds that is needed in terms of what is going into the company, because what you're going to achieve will be achieved by various different means or resources or different activities you're going to conduct. So you will give a breakup saying this is how I'm going to spend this money roughly. You'll typically 4 or 5 activities will be there where you're going to give that breakup, and you will need to let investor know that this is how my money will be creating an impact. This is how the money I'm going to get from you will be creating, how it is going to take my venture where I stand today to what I'm promising to you, where I'll be after 18 months. And that articulation is extremely important because that's what tells investors after spending this money, what can they expect you to look at into in terms of going into the next round as a part of that, right? I'll take a pause here. I'll say if there is any question which for clarification of anything that I've spoken, I'll be happy to take the question if there is anything. Yeah, I think there are some hands raised. Can we have the question, please? Is the question in the chat window? I don't see the
I
question.
have given access to speak for people who have raised their hands.
Yeah.
If you have any questions, you can ask.
Please go ahead.
First, we are not able to hear you.
Or otherwise, if they have typed, you just read Anupama, help me.
I don't see any questions.
Okay, I think maybe they're having difficulty in terms of if you have questions, please, if you're not able to, your voice is not coming, just type it out. And if team gets it here, they will convey to me. I'll take it.
Dinesh, I have given you permission to speak.
All right.
Am I audible?
Yes, we can hear you. Please go ahead.
Sir, thank you very much. It's a wonderful help for the startups. So I have a question about, when we talk about revenue part, ARR makes a lot of sense for startups which are closer to revenue, right? The final product commercialization. But startups, a lot of startups would be in the early stages of development, and specifically deep tech and research. First 5, 6, 7 years goes in just like say prototype or even going to the early validation phase. So how to convince investors over there, compared to when you are very close to generating revenue, it becomes easier. So the funding valuation becomes a challenge. Getting a fundraise becomes a challenge. So any pointers on that, sir?
I get it. So I have a very specific portion of that I'll take you through in terms of early stage versus the latest stage in terms of what investors look at. I will cover it there.
Okay.
And if there is
Thank
still
you very
remaining,
much.
we will clarify there later.
So can you hear me now, sir?
Yes, we can. Please go ahead.
Yeah. So we are into deep tech nanotechnology based solution for renewable solar industry. And I completely agree with you that, raising money through equity is a very big, it's costly. But when we try to raise money through debt financing, when we are raising money because of order situation, we already have orders in hand and we are looking to execute those orders, and we need working capital. But banks don't give money, and they need collateral, or they would need the company being profitable. And when you go out to other NBFCs or other financial institutions, the rate of interest they charge is something like 20 to 25%. So it becomes a chicken and egg situation. In that case, we have left with no choice but to dilute, sir. So how do we overcome that situation?
So, and I tell you, in last 5 years, the cases you're talking about, I have seen many of them, and they are some of them very industry specific. I mean, you talk about this kind of thing, solar panels or solar technologies, or you look at it in terms of water purifications. I have seen sectors and the segments where this challenge is quite acute, actually. Now, in this kind of scenario, like you talked about, if you don't get any financing support from regular standard channels, which are banks or in the debt, whatever, going to equity is okay as long as you understand the amount of dilution you are doing and after taking that money. Because one of the key thing I have seen that after taking the money, people are not able to use that money to come out from that, the chicken and egg solution you're talking about. Then you actually you get into a lot more difficult situation because now you have raised the money, you have diluted, and you are still in the same situation, and you are again going out to the market to ask for the money, and that will make sure that you are totally dependent on external resource. You're not able to come out from there. So two things which I'll tell you: one, if you do want to raise through equity, it is okay if you understand the value that you can create. So it is like a responsibility. You're saying that this much part of me is like taking, I'm going to cut off my hand and going to sell in the market. So if you're going to do that thing, you're making sure I don't have to cut my other hand. So you create the value from whichever way the growth that you want to bring in, the amount contracts you want to get in, those things you deliver, and then make sure that you don't get into same situation again. So that's one part. Second part is in this kind of scenarios, even if you have to take, and this is again a personal call which founders will have to take, but lot often the requirement that comes in either is a one time that chicken and egg problem that they are into, or it's a cash flow issue happening where they do have demand but they don't have that immediate cash available to convert that demand into a project and actually start making money. So if you, let's say, if you're getting at a high interest rate, but it is a controlled risk. If you know that this is your calculations, right, that if I'm going to raise this thing, I'm going to get this much money within 6 months, I'll be able to, let's say, pay back by either the advances that coming from the project I'm going to do or from the money that I'm going to spend to that. Yes, it is a cost to business. You can look at it. So do your in your calculation saying I'm going to raise this much with this much of percentage of that interest I'm going to pay that. But if I do that, the contracts I'm going to take in, they are going to take me out from this loop. And after that, I have an opportunity to run through there because when you go to investors, and some of these things we will see as we move forward into the deck to see what is investors are looking into. And I will look at some of the asset heavy startup considerations as well. So interest of time, let me move because some of the other things which some of these questions actually will get answered as we move forward. And what I will want to next look at it really what we call is the battle of deals. When you are going to stand in front of investors, what is it that you look at the gates that you pass through? How do they really look at? How do they filter everything? So you know where you are dropping off. What is it that is finally getting dropped off, right? So you again look at it. First thing where everything begins when you are going with any investor is their investment thesis, right? Now this is something which is their thing, which is not about you. It is about if I'm an investor, I'm choosing to decide that I don't want to put money into, let's say, clean tech. I don't want to put money into, let's say, SaaS. So it is, as an investor, my thesis says that this is where I see an opportunity. This is where I'm going to put my money. This is where I'm going to raise my funds. And I'm going to bring in the companies whom I want to bet. So this is a thesis which investor has. So when you are going to reach out to the first gate at which most often the things will get dropped, picked is, which is about the investment. So if you don't fit into that, if you are, let's say, a clean tech startup and you are landing up with an investor who might be spending huge money giving funds to a lot of people, but he is giving only to a software guy, and your technology is not fitting into that SaaS kind of thing, they are not going to bother about your startup. So they will look at your tech, they'll pass it on. That is not failure for you. It is like if you eat only vegetarian, and if you stand in front of a non-vegetarian restaurant, he's not going to serve you vegetarian food. So it is not your failure. You say, oh my God, this guy is not giving me food, right? It is purely a selection process. So you need to be aware. If you really want to have an efficient fundraising, your research is very important, how you reach out to investors. So you need to understand the investment thesis of individuals or the funds or the institutions who are giving money to see what are they believing in, what are they. If you don't fit into that, don't waste your time there, because you will end up, even if you know individuals personally there, if their thesis doesn't match, very less likely that they are going to put money at the closer of the deal, right? So that's the first gate. Second gate, if you get in, if you fit into their thesis, what they are going to immediately look at, because at this stage, they are just getting to know about your venture. They are looking at what have you got, what are you presenting to them. So first thing, they look at your core DNA of your venture. Is it designed for success? Is it built for success? The very basic fundamentals. And we will see some of those fundamentals, what goes into looking at the venture success. But they will look at that. If at that level, they don't have belief that what you have presented to them in terms of a core DNA of a venture is going to be succeeding, they are going to drop off from there, right? Irrespective of how much impressed they might be with your pitch or whatever, but they don't believe, let's say, market is too small. They're saying it's a fantastic innovation. You have built a complete breakthrough new technology, but the amount of business that it can generate is going to be very, very small. So they might be too impressed with your technological excellence, but then it is not really something which they want to bet upon in terms of a business. So they may drop there, right? So this is the second gate when you look at it. If you cross that gate where essentially they have looked at your core venture and they find that it has a value, they might be interested in that. This is where they look at the actual evidences. So now structurally they are interested. They say your concept looks good, your idea looks good, but VCG here is basically value, commerce, and the growth. And I'll take you through that thing in more detail. They want to see the evidences. Okay, have you got what you are selling to me? Have you got anything to back it up? Or it is all story. It is all just basically a concept kind of thing, right? So they want to look through that. And that is they will do their basically a risk assessment, and we'll see through some of those risk factors as well. If that is where you are able to basically satisfy them, okay, looks like this is a good bet. You've gone through all the three levels. That's the final thing where you look at it is your basically pitch delivery, which becomes the last gate. So when you are pitching to them, you might have, and here I'm saying not in terms of necessarily time sequence. I'm telling you from a gating perspective. So for example, their thesis, your startup in principle fits in. You might have a venture which has the core DNA is very good, and you have got all the proof, but you might fail in communicating it. You may not be able to communicate it properly, tell the right story, tell the right kind of markers, tell the right kind of presentation, and there they don't get really confidence. So it's like a communication gap. You have got a good stuff, but you haven't been able to show them the good stuff. You haven't been able to tell them they have a good stuff, and they haven't got it, and they do not have so much of time or energy or patience to be able to really dig so deep. So the burden of creating that conviction and creating that interest is on you. It is not onto them because they're already burdened. I showed you the number. That was the purpose. So burden to prove that you are the best candidate to is onto you. So that's in your pitch delivery. It becomes a very, very important because that is the window that is through which they are looking at everything. You know everything, but you are the ones who are letting them see what you want to convey. They don't know anything what is there in your startup, right? So what you communicate is what the truth for them. That is what is how they will judge. So your delivery becomes important, and hopefully tomorrow's session, you will get good insight in terms of how do we, if we have got the good stuff, how do we communicate that good stuff so that you don't miss out on the opportunities? Because that's a very big segment. I've seen huge number of failures happening because founders not being able to really communicate what good they have got, but they have got brilliant stuff. It's just that there are so many choices. How do you say your things? And they often people just take the whatever the least resistance way of telling it, and that doesn't necessarily tell the good picture, right? So this is what the gating mechanism you should have clearly. And in this scenario, why this is happening? Because investors actually bet on the probability of the success. That's what they're doing. Neither you can predict nor they can predict whether this sector, this particular startup, this idea, or whatever, any of them will be successful. You can't predict. But they are also basically betting on a probability. So every piece of information that you are giving to investor, they are doing the calculation, their machinery is running. They are trying to assess that whether this has a good chance of success or not. This is what is going on in their head, in their top to bottom entire team. That's what because look at the number, 5,000 pitches converting to 3 bets. That's what they got to take. So that's the amount of care they need to have to make sure that the probability of success they are able to guess has to be there. And that is reason why we need to understand this success. What does this success mean? How do we know what is it that success will? Because everybody is looking at that. If you become successful, that's where the investors make money. That's where you grow in the right. So if that is the case, the question becomes, what is it? How do we really define the success of a startup? Get me get me some ideas. What do you guys think? What is the success of a startup? How would you see from this gathering? Can be people simply, I mean, just one word or one couple of words. Can you just tell me what is success for you when it comes to a startup? Or how would you say? Can we open up mic for people to speak?
Yes, but I don't see hands raised.
Any hands? I mean, this is something which, if you are aspiring for
So
success, you must know what success is. Please come forward.
customer acquisition, deliver value to customer, moving into human trials, revenue customers, product market fit, revenue generation.
Providing value to the investor and
Adding value
shareholders.
to.
Increase value to stakeholders, market fit, growth month on month.
Wow. Great. So good. Now, what are we seeing it here? We are seeing the lens through which what we are calling success. It's not looking like one single thing. I can tell you this happens and that's what is success, right? It is not a single thing. Success is essentially a phenomena that comprises of a lot of things. And whatever people have here, I have heard, whether in terms of acquisition, whether in terms of the moving into trial. So something like trial, what are you talking about? Again, this is your a next milestone success, right? That's not the ultimate success if you're a startup, you look at, right? Once you succeed in a trial, you look at the next phase like that, right? So success is a journey. And the way we define, so we will look at what I'll give you a very simple way to look at how do we consider, because a lot of time the dynamics of how somebody is assessing you as a successful startup or looking at the potential, it goes through those kind of thought processes. So I'll give you a very simple framework to think how do we look at success, right? So the first most important thing for you to succeed or become successful is a create value. We heard about that creating value, whether for you investors or for a customer. Here we are talking primarily from customer. Starting point is that if you are bringing out a business, the most important first principle for this is creating value. If that is not there, anything else downstream we're talking about is not what is going to work. So first thing we say, you must create value for your customers, right? Now, creating the value, again, the way we look at it, it's not just creating value in isolation, but look at it as a journey. What happens first thing is, if investor need to look at you, they need to see a big potential of the value. So it is, if you are a very early stage, like people talked about that, I don't have really a client, I don't have really. So at this stage, what am I doing? I'm assessing your potential, value potential, based upon either your IP or based upon your concept. I understand your potential. Now, the second thing which I'll worry about is your value realization. The potential is very good, but can I realize my value? Do I have the necessary engine, necessary structure, necessary process where I can convert the value I'm promising and realizing that value for my customers? But even if you realize that value, often as you want to grow in the journey, it is not sufficient enough. You look at it, can I sustain that value? Because with time, with market change, technology change, scenarios change, that value understanding changes with the customers and their scenarios. So that's the reason when you look at value, so the dimension we are worrying about here is the value, how your startup creates a value. And you go through this curve where you have initially early stage, you'll be having a potential. That's what you'll be judged upon. Then as you little bit move forward, you will be judged upon how are you realizing that potential of the value in terms of customers experience. And then if you further move as you grow, it will be seen in terms of how are you sustaining and defending your value. So you had one time you converted, you realized that value, you have shown it, but are you able to defend that value? Or is it that your game gets over in 4 year or 5 year and after that, there is nothing to look forward to? Your value is diminished after that, right? So how do you look at the value sustainability? So this is the dimension of the value where you look at it. How do you succeed there? Your success goes through this curve. Having a potential, realizing this, sustainability. Now, potential to realization to sustainability is a generic progression. Now, we will look at the next important factor, which is how do I convert this value into commerce? Now, this is where I have seen large number of deep tech or technology-driven startups where they have fantastic value equation. So they have created a product, or they have created a technology that's delivering value, but where they are actually stuck is not able to convert that value into commerce, converting this technological excellence into dollars or into rupees, whatever that is not happening, right? So here we have to apply the same principles we talked about. you have a good commercial potential. I'm going to judge that. When I'm looking at how your value converts to your potential, your technology converts to a commerce, I'm going to look at that. What is the mechanism have you got? How are you going to convert that? How are you going to realize it? So potential wise, like you say, it's a huge market. Yeah, it's a huge market. That's a potential. How are you going to acquire that market? So the realization of your commerce, I'm going to look at that. And then I'm going to look at sustainability, that once you're acquired, how do you stay in the market? How do you grow in the market, right? Now, after value and after commerce, these two things when you've got, often what gets ignored where people don't pay attention much is the growth scaling. So this is where this third factor, and which goes through the same curve essentially. You're talking about your growth potential, you're talking about growth realization, and you're talking about growth sustainability. So if you look at in this scenario, what are we showing here? You got three dimensions. You got value, converting the value to commerce, and from the commerce, basically growth. And each of these three dimensions will basically move into progression, having a potential in the beginning. So if you're coming to me with the idea stage, I will look at your value potential, I will look at your commerce potential, and I will look at how would you grow, your growth potential. Because even if you have a high value potential and high commerce potential, and if you don't have a growth, essentially you'll get stuck somewhere. You're not able to move beyond, and you will not be able to really become an investable company. You may still be a good company to operate. So that is not a question, but it'll be more like a lifestyle business. It's good for you. You can manage your funding or financing through other mechanism. But if you don't have a growth potential, I'm not going to be really be interested in that, right? And similarly, then when I look at it next level, I'll say, how do you realize? So it is little, you're talking about pre-series, that kind of thing when I'm talking about, they are really going to focus upon potential is not what they'll care about because you're already beyond that stage. So I'm going to look at your realization. How have you used your structure in terms of your team, in terms of process, in terms of your GTMs, in terms of your money deployment into various different operations? How have you used to realize your value, convert into a commercial, and have you been able to show any element of growth as an evidence, right? And then if I'm getting into which most of you at this stage probably may not be applicable, but it's good to keep that thing in mind as an investor psyche, that they will also look at, would you have a sustainability issue? That everything looks good from your potential to realization, but for you to sustain, it is going to become a challenge. Then that may be the one where because of which they may pull themselves back, may not do that, right? So just keep this framework in the mind as we discuss many of the things downstream. This value, commerce, growth as the fundamental consideration in terms of what is it that you are being judged upon. And based upon your stage, it's looking at potential, realization of that potential, or sustainability of that potential. This is where now after having seen this thing, what is the next thing that is important for us? As an investor, when I'm looking at any proposition, when you come to me, give me your deck, or you talk to me and you're presenting your idea, constantly they are tuned. All the investors, if you look at it, they are like a machinery they run. So it might take you and I who are not doing it day in, day out, that assessment, it may take a while to think about it. But they are so tuned to it, the moment you start talking and presenting their machinery of assessment, quickly start tuning it up. And they start every slide or every part of your deck, and they are quickly is going color coding. It's red, it's green, it's yellow, where there's a risk, that kind of thing, calculations going on, that type of thing, right? So we'll quickly look at it. What is the risk map? Where typically when the investors look at it, and how do we really counter that risk? I think there is somebody who has raised the hand. Can we give access to them for talking? Can you please
Hello.
speak if you have this access? No, I don't hear anything. All right. So then I'll move on. So let's look at the risk map and the evidence graph. So here, when you begin, you essentially start with the first thing which we saw, value risk. So investor first thing, look at it. You are giving them a story, telling this is a problem, that is a problem. Is the risk, if you assess is wrong, if it is just your, often people come, oh, I have spoken to 5 people, or I have connected with these 3 companies, and they are telling that this is a product, they have a huge problem like this. So essentially looking at the proof of the problem, is it really that big a problem where they should pay attention? Is it a global thing? It is something which is that kind of scale. And they also look at the proof of 10x value, that can you, whatever you are telling them, will you able to actually generate 10 times bigger value than what is current state of the art in the market? Now, 10x is, as most of you probably might know, more than just a quantitative view. It is more of just as a representation of that a scale of value differentiation. That what I'm offering is not 1.5x or 2x kind of thing. I'm talking 10x, which means I look at the value promise that you have, and immediately it hits me saying, oh man, this is something which is doing, which is not ordinary or not a regular run-of-the-mill anybody doing a business. It is about something you have changed something in the industry, that kind of thing, right? So this is where what the expectation is. Now, if it is not 10x, it's 7x or 5x or 6x, those are more to really look at the spectrum. But the idea as a representation is that can they immediately get that value jump in their thinking, oh, this is what they are doing is very different, and it's not what I'm seeing in the other pitches. Second is the market risk. This is where we'll look at it. What is the proof of customer demand? How much customers are really behind you or they are asking for it, not just from you, but in general market, what is the customer demand and are you able to tap into that demand? And then second is what is the proof of solution adoption? So here we are talking about adoption in the sense customer is able to take your solution and put as a mainstream change in terms of their behavior. If it is a enterprise, are they changing their core processes to use your solution? If it is a business which is using, have they changed some of their business dynamics by using your solution? If it is a B2C and individual, you're talking about are individuals actually changing their habits or their way of living or way of doing things by using a solution. So you look at, and this is how, and these are some of them example I'm sharing you to you understand when you say evidence graph, it means that you should be able to show these evidences so that the risk perception they have, it should be able to bring it down. Similarly, solution risk, which is more about your product and technology, you look at it, what is the viability? Are you at a stage, are you able to showcase where it is a viable solution? It is something which is fully functional, working, there's no technology risk in that. And you also look at the proof of solution performance, which means how well my solution is performing from the promise from a feature or functional perspective that what I actually got. And then we talk about defensibility risk. So whatever you got, how would you defend from other? It's like a competition in some way, look at it. How competitive are your thing and what kind of barrier have you been able to create through various means? So do you have proof of, because competition, one is conceptual. You can show them the slide saying, this is how I'm better. This is the type of things which I have a distinct advantage, but those are concept. But when you look at it, one that you have proof of IP protections, that is a defensibility. Other, you're looking at competitive wins to show them, look, this is where we have been able to, these are the kind of players who are competing and we are able to get the orders. If you are in early stage, typically defensibility is a lot more going to be heavier onto conceptual side. The burden is going to be where you're able to show them any kind of barrier you are creating for a competitor to get into this business or execute this business or take it from you is what will count for you to create a defensibility protection for you that they will care about. And then they will look at the business model risk, which is more about whatever business model you're showing them that there's a customer, there's a product, how you're going to actually have the product going to your customer, all of that entire business model you're designing, what is the risk in that it will work? So proof of the commerce that actually customer has a willingness to pay, not just willingness to use, it is the willingness to pay. Because a lot often we say pilot is done, customer is actually wanting to use it, but when you finally take up a price point and you go to the customers, you really see a drop. You're saying from 10 customers or pilots, suddenly you are bringing it down to just one customer who are willing to pay that price. So you need to be aware that your pilots, if they are not having any commercial value attached to that part, that doesn't de-risk your business model. It just proves solution. It may be proving your maybe value, but it doesn't prove the business model there. So that still need to have a commercial value associated with that. And then similarly, unit economics, which is basically you're talking about when I'm producing, manufacturing one product or deploying this product with the customer, what is my unit economics of this business? What is it, my total cost that is going into manufacturing or taking to the customer? How much I am getting the revenue or the money I can charge onto this one single sale, and what is really my profitability with that one single sale level. I'm not talking about the whole venture level, but unit level, every item, every sale that I'm doing, what is the economics for that sale? That what is the proof for you? Are you able to show that thing in your books and that? And similarly, the proof of distribution. Likewise, founder risk, I can't stress more, especially if you are in early stage. The lot of assessment goes into in terms of them assessing you because they don't have anything. I mean, at best you have got maybe some technology thing to demonstrate, but huge amount of assessment if you are in early stage goes on to investors assessing the founders in all dimensions. So they will look at it whether you as a founder, your fitment to the market, the sector you are into, the kind of business you're trying to do it to. And also they would want to look at it, your skills, your experience, your track record, trying to get to really, if I'm going to bet upon this team, even maybe great idea, great market, a great solution, all of that thing fine. But is it the team that finally can actually deliver enough and take it to the end to be able to win this game? It's like a Formula One car, right? You might have a fantastic car, but in the same company, same car, you got two different drivers. One, if it's a highly skilled and experienced one, if he is able to win, this is where they put the money on, because car is infrastructure. It is given to everybody. That is part of every company's, their car performance. So car is also, good car is required. And that's where we went through this VCG analysis. That's what your car is. But the founders are the one who are sitting in that. If that thing fails, then other things are not going to matter for investor that. So having that representation, having that projection to investors, whether through your communication, through your profile, through your public perception, whatever is available for a founder's profile, that is equally an important component for them to look at that. So this gives you idea. See, this list of actually evidence graph is a huge. I mean, usually when we work with the customer, anywhere when risk assessment is done, you're talking about 20, 25 items where you go through in terms of looking at creating the right evidence graph that you want to associate and take it to your investors to prove that what you have got. Now, depending upon your stage, if you are in early stage, you probably may not have 20 proof points. You might have out of these maybe 5 or 6 proof points you might have. But if you are going to look for pre-series A, series A, then the need for having the more proof point becomes much, much bigger. Okay, so let me quickly, now we looked at in terms of understanding how investors, the way they look at their risk perception. Let's quickly look at in terms of when you are now starting a journey, especially if you are a first-time founder, you just need to quickly get an understanding of investor engagement journey. What happens between you and investors in terms of the overall journey, right? So again, we look at 2 dimensions. Look at complexity, and this other is a timeline of interaction or of what is happening between you and investor, right? So it will begin, first thing which you will battle is about investors' attention. This is where we looked at 5,000 pitches that they are getting, and they are doing a deep dive with the 500. That is all about attention. So those who are able to get the attention, that's how the 5,000 is converting into 500, where they are doing the deep dive. That is what is the conversion. So first, your battle will be where you get investor attention, able to do, whether in the pitches or you're sharing the deck or you are going to any programs, participating, how do you get the investor attention? That is your first battle. If you are able to get their attention, they have looked at your deck, they find, yes, looks like something which may have valuable. That conversation need to conclude into what we look at a second stage as the basically term sheet. Now, term sheet, those who already have raised, they understand it better. But idea of term sheet really is that out of your conversation, you and investor have some sort of understanding of the broad contour of your deal. Very high level items, whether it's valuation, some of the key terms, what are the conditions they're going to put forward, what is the kind of money you'll raise, all of those, the broad contour of what is the overall design of your deal, that actually gets agreed, which is called as a term sheet, right? So you will move into that. If you are getting a term sheet from an investor, that is in a progress on journey is a significant milestone, because that tells you that they have done the due diligence and they now feel that they are ready to move ahead to offer you, make it. So this term sheet is an offer, but this by itself is not the deal. This is just an offer, agreement to understand that if we are going to convert into an actual deal later on, this is what is going to be agreed terms, main terms. And if you have crossed that barrier, then the next one, which is basically deal closer. Now, between the term sheet and a deal closer, also deal can get dropped. Simple things like your due diligence is happening. There are deal breaker things, which we will see quickly. I'll take you through just to give an idea that they may discover, they may find things which after giving the term sheet, because term sheet at that level, the due diligence is not too deep, but they have done good enough to understand that, yes, it has significant promise. And we know enough now about your company to be able to basically give you an offer. But even from there, the process begins. They will get into more deeper due diligence from that point. And before the deal closure happens, they will go through things, whether it's a technology, whether your customers, whether your founders, your legals, your companies, a lot of these things. And I'll show you some of those representative things that the typically investor will go through. But from a complexity and timeline perspective, look at it. Getting the attention itself is one of them. That is what initially you'll battle for a very long period of time. So from attention to term sheet, this is where if they have found what you have good, Usually they will go through their internal assessments. Sometime they may wanting to close it, but because they may be looking at multiple startup at the same time who might be doing the same thing, so them converting it to term sheet may take time. Even though they have shown interest, it may take time for them to finally do that assessment, look at multiple startups, and finally agree that this is the startup I want to finally go with and make an offer for you. Term sheet to the deal closer, that is entirely a transaction, which is you can look at it all dependent on actual activity of the transaction, which is could be due diligence, it could be the clarifications, it could be the their preconditions which they have that necessarily need to close at your end as a startup. But you are now into the transaction. Once you got the term sheet, you have accepted it, and you want to convert into a deal, you will basically go through as a part of the process to convert into the deal. So unless something is a deal breaker comes in, you more or less have just that. So a huge amount of this negotiation, part of it will happen from attention to term sheet, but there is still going to be a lot more fine prints which are going to come when you convert from a term sheet to actually shareholding agreement where the deal closure happens. A lot more is going to happen in discussion as part of that. And that's the reason you will see here the complexity factor between the term sheet to the deal closer becomes much higher. So I often advise, see, at the end of the day, this financing, this part is actually a legal process. And hence, if as a founder, if you are not very well versed with these term sheets or the deal closer legalities or those kind of structural understanding, it is always a good idea to get a legal counsel, get that help if you are part of incubators or if you're part of any other such kind of help structure. They often will be able to help you out with the people. But take those things very seriously, because one wrong understanding of the term or signing off where you did not understand what it mean could actually make it very restrictive for you for the future deals. And these are early stage. Most of you are at early stage. Early stage is the where you're most vulnerable actually, because at this stage there is a huge amount of, in terms of range, what can be negotiated. So that's the reason if you're not very comfortable in terms of understanding, firstly, I think as a founder, I always advise, make your effort to understand those things, but because it's your company. At the end of the day, you are signing off. It is like if you're going to buy a house, you better understand what is there in that house and the way whatever your agreements or the way your all your deal design is. Otherwise, you might have spent your money, bought it, and later on you do realize that there are issues are there which are going to cause problem for you, and you won't be able to fix it later on once you've signed it. It will be very, very difficult. So you make yourself comfortable with some of them. And if you still believe that there are things which you need help in terms of closing it, negotiating it, there are legal counsels available who can help you, because that's what they do. They will be able to negotiate with the investors and on your behalf to be able to get a good deal to you, right? So from a number perspective, again, as we said, 50 plus investor attention, that's what usually you will have to go to and basically pitch minimum. You might get, maybe if you're lucky, you might get 2 to 3 term sheets. You might be having multiple term sheets coming in from. Sometimes investors do put up that condition that if you get one term sheet, if you get their term sheet, you cannot shop around in the market. You cannot do that. But if you had, let's say, earlier conversations are there, and through that you have received it, and those have not moved forward because of various reasons, could not have an agreement on to closer points, they may still remain with you. So you may end up dealing with 2 to 3 term sheet, which may convert into one single deal for you, right? So this is how the whole journey is looking like. Now, given that 50 plus investors you are going to go to, it invariably means that you are going to have, if you're going to get 3 term sheet, let's say, 47 investors are still saying no to you, right? So often, even though, let's say, next one, let me get into, we're calling it as a rejection, but actually that's a very misnomer. As I told you, given the same example, this veg versus non-veg. I mean, if you want to eat vegetarian or non-vegetarian food and you go to a restaurant that is not serving it, that's not truly a rejection. It is just about not selecting. So they are looking at what works for them. Now, what you are offering to them may not be in that particular entire matrix fitting into what really they want. So you are just not fit, as I'm saying, as a startup to basically for their purpose. So if you haven't got something which is exciting them and is not fitting into that, and we will run through some of those, what are the typical thing that you should look at it before actually you put in front of investor, because so that you can avoid your time wastage. You should not have, because your time is precious. Every hour that you're putting into preparing or pitching, you are not doing your business. Your company is not getting your time to do the business. So you have to be very efficient, right? But here, in terms of when you look at it, how do we navigate when people are saying no to you? Just understand the dynamics, what is happening. So you look at it when you are at a certain stage, what is happening with investors, how easy, if they have said no to you, how easy it is to fix and get them to yes. So that is the one dimension we look at it. Other, we can look at it when they are saying no to you, how big is that loss, opportunity loss for you at that stage, right? So you look at it the first where we talked about thesis misfit. When you are not fitting into that thesis. Now the gate gets closed. If you're not fitting into the thesis, you cannot negotiate. There is nothing that you can do to actually make investor look at you. So it's just you let go. You don't have to reconsider. You just understand that that particular investor or that particular lot is not a right kind of investor for you to get into that. So it is a lost opportunity because it's not fitting into you. You don't worry about that thing at all. If you are into where you have a proof gaps, which means that investor has said no to you because you could not produce a sufficient proof of your whatever you're claiming in terms of success or progression or anything, they haven't got enough confidence. Now that is reasonably, I mean, between somewhere easy and difficult. It's not too difficult because it could be a communication issue. You're not able to communicate, so you may still have, or sometime what happens that today if they have said no to you, it is a good practice you keep them informed as you meeting your milestones. So today you may not have that proof. Tomorrow when you can again go back because that's their door is not permanently closed. If you have got those proofs, you can again go back to the investor and you can actually restart the conversation and do that part, right? So it is at this stage, even though it is serious, but you will be able to fix it if you continue and if they are able to find a value into relooking at your. But at the same level, if they see there is a structural problem, there is a basic DNA problem in the venture, they don't believe into that, then that is a very difficult to fix. That is more like a thesis misfit only. So even though you fit into their thesis, but in their assessment, they believe your structure, the way your business model or the entire thing organized, they don't believe in that. In that scenarios, it doesn't matter how many times you go back to them and what other things, unless something really big happens, which totally changes their judgment because they might think they have misjudged you. That also is possible because at the end of the day, it's their judging thing. They believe that their DNA is a problem, while in reality, you may not have the DNA problem. It is still because of the perception. So unless something changes that, it is very difficult to fix that. And at the lowest level, pitching, which we always say, it is very easy to fix. I mean, at the end of the day, you are not getting an offer because you're not pitching it right. It is only a temporary problem and it is only a temporary opportunity loss. You should be able to basically get that sense from your assessment that I'm not getting it because the way I'm pitching, the way I'm communicating the value, the way I'm communicating the model, the way I'm communicating all the things, I think somewhere that connect is not happening. That maybe through the feedback from when you're pitching. It is always a good idea, even if you don't get an offer, to get an idea where are they stuck, what is it that causing. Now, when you see after their explanation that the way you are thinking in your head and the way they have received it is two different levels, then which means you need to fix your pitching. You need to better present that. And that is easiest of the problem to worry about. If you have pitching problem, you can fix it. So this tells you really look at it in terms of if you are hearing no from investors, that no could be of any of these level. And you need to be able to know that where I'm getting this no from and whether it is fixable, not fixable, how do I need to take care of that part, right? And when you are getting a no, let me quickly move into the next thing that we talk about, the deal breakers part. The things that absolutely no matter what else you have, if the investors are going to encounter some of these things, they are going to be almost like a deal breaker at any stage. Even if you are just one signature away, at that point of time, if there is anything comes from you of any of these nature, you are likely to lose that deal, right? So one is your unreasonable valuations. Especially this problem is more prevalent into early stages because the basis on which the valuation typically is done, that does not exist entirely. While for the Series A, Series B, of course, the valuation more formally happens. There is structure to it. So that is, you could still take a stand saying, yes, my structural valuation is this much, but I don't want to agree below this, which is a negotiation. But often in early stage, if you are, I've seen founders who just have that stuck in their head, look, I will not take anything below this, while they don't have nothing to offer to justify that. Those scenarios, investors will not haggle. They will simply say no, they'll move on from there. Or the second thing, which is a founder issue, which is a very, very critical thing where whether in terms of integrity, when you're talking about whether that thing is visible through the transactions, your conduct, or anything they have seen in your records or your company's handling, or through their interaction with them, which could be either maybe could be dishonesty, or it could be where you are having hiding things, those kind of issues where integrity, or it is a conflict among founders, or they are sensing any kind of commitment issues with the founder where I don't know whether this founder will continue, or they are committed enough, or they are serious enough, that commitment issue. Or there is any kind of indication of a financial recklessness, like the way you have spent the money in the company, the way money is being used, or the way the financials are being managed, any of that thing. Some of these things investors take very, very seriously for them, because for them this is where the root is. If the founder issues are found, no matter what else you are put on to top of that, it is going to fail from there. So they take that thing very seriously. Often the third thing which they have challenges with the cap table problems. Cap table problems, some of the thing, for example, look at it, you may have part of your cap table promoter or a founder who is totally inactive. So some of the scenarios I've seen, it could be a family member whom you have got in early stage as a part of your company. You're given, let's say, 30%, 40% equity, but they are not really part of your execution team. They are not really delivering anything or taking care of anything there. They just in early stage would have come in. That is the one kind of issue. Or in very early stage, you have diluted too much equity. So in a cap table, you have some very early stage investors are sitting, could be pre-seed investors, and they are having a significant equity with them, which later stage startups, investors do not want to have them. That is, or any kind of regulatory or legal, because some of these things are not negotiable type of things are there. If they find that there are, for example, if your company is filled with the regulatory problems. Now, if they are really, really interested with your company, they might give you that leeway saying, I'm giving you 2 months, fix all of these selling, clean, make your financial clean, or make your regulatory compliances clean, all of that. They may give you that. It depends upon investor to investor. If they have got some other options, they might just move on. But if they think that, no, this is a company I would want to really work with, and they trust in you, and it just could be various reasons why you landed up into regulatory challenges, whatever, they may give you that leeway so that you go through and fix that problem. But it is advisable from the day one, keep your finance, books, regulatories, legals, all of these things, keep it clean. Do not save it for, oh, when we raise the fund, when we become a big company, then we'll worry about all that thing. Do it from the day one, even if it's a hassle, it's a burden, but do that thing, because some of these things are there. If you keep cap table clean, keep the regulatories clean, make sure that whatever be the in terms of the due diligence item, they may look at it. It just expedites. It just helps you accelerate after they have done the basic thing. Rest of the moving from term sheet to closer, it becomes very easy because you have taken care of all of these things, right? So this is more about really looking into in terms of where the deals may go wrong. Now, one of the items here often, and I think some of you asked question about this thing, is navigating the valuations, which is quite, often gets controversial. Even though we feel that there is a system to it, there is a method to it, but then still, even last 15 years, I've seen so often in discussion with the investors and the founders, it is all over the place. People have different kind of expectations, or they have different experiences, or they have different demands, and that matching becomes difficult. Now, on a founder side, yes, not every founder would have gone through, or would have understood, or would have that experience of really how do I value. And especially in the early stage, we talked about it. If you are in early stage, it is a challenge. And if you are really early, actually, the truth is that in a very early stage, there is no valuation mechanism. There is nothing you can do. Your word versus mine, as good as it. So that's the reason you will see often in a very early stage, there are mechanisms like convertible notes, where essentially we agree that at this stage, even though potential looks good, but there isn't a real marker through which I'm able to do evaluation. And hence, you, instead of directly going for a equity deal, you look at equity conversion basis. Or like in US, India, though we do not have very popular, there's something called safe note, which is essentially allows you to, at a later point of time, or at a certain event, convert your promise to an equity. Or it could be convertible debt kind of thing, where you start like a debt, and you pay them the interest. But at the time of, let's say, next fundraise, you give them the discount and you convert them into. So that becomes a very, very useful for early stage startups, so that you're not wasting time or you're not breaking your head onto the valuation, because it is difficult. If you haven't got customer, you haven't got any revenue, whatever, then it is more about really the matching investors' perception versus what your demand is. Where do you match? If it matches, good. If it doesn't, then you just keep going from one investor to other. It's very difficult, right? But talking about in terms of the valuation structure per se, the direct factors often which will get used for doing the valuation: your annual revenue, your IP, your financial projections, and your deals pipeline. These are about businesses, right? So often you would have heard, let's say if you got in whatever annual revenue you are making, a very popular back of the hand calculation, people do 10x. They look at it, if I'm doing $1 million annual revenue, I will, it's a okay safe, or it is something which you can look at in practical terms to ask for a 10x valuation of that thing. You should look at it. Now, it could be 8x, 10x, depending upon the industry, whatever, but that's a range kind of thing you look at it. Similarly, if you are really building a solid IP, your company is a more really a hardcore IP driven business where the IP plays the main role. And that tomorrow this IP itself can be the something as a big asset that could be sold or whatever. Then as a part of valuation, the IP itself will be valued. So apart from the business, we talk about revenue, everything, but the core IP, let's say if it has taken for me to build a particular IP, it has taken 8 years, and notionally, because often what happens when you build the IP in early stages, we are not paying salaries, we are really consulting a lot of experts, but we are not really doing a commercial compensation for all of them. But if you consider what it takes to build an IP to the stage you are in, and it is a very, very critical IP, there is a value for that IP. So you can actually have the IP valuation done, and you can put as a part of your valuation as well. Similarly, the financial projection. So this is about future. Revenue is about past. You are telling historically what I'm or where I stand today, what I'm closing, this is where I'm valued. But your projections, if they are justified by the mechanism, by track record, or by the various structure you have created, and you have a fair way to, in some way, convince that these projections, which are not ordinary projections, that also become a basis how you can add value and factor in terms of your valuation. And another thing which will be your deals pipeline, even though they are not converted, they are not your customers signed up, but there is a deals, almost you can look at like a verifiable deals pipeline available that you can also use as a part of the valuation. So these are the direct factor. But there are indirect factor. Often I've seen founders don't take into account when they have to justify their valuation, or they have to actually do the calculation. Look at the industry comparables. The kind of thing you're doing, look at the industry, people have already raised the funds. So that gives you a benchmark idea of saying what is it, the same stage, same kind of product, same kind of thing. What is it, the range, what you're talking about? Is it the valuation going at $1 million, $10 million, 20, $100 million? Where is it now there? So that is something that you can use as a comparable argument to be able to justify what you have it. You look at your growth factors, how you are year on year or month on month, you are growing. So your growth rate, that becomes a negotiating factor, because what you may find that your competing companies which are there, they may not be having the similar kind of growth rate, even though they technologically might look similar to you, but may not have that kind of growth. Growth becomes a real business. So that becomes a instrument for you to be able to negotiate. Your unit economics is a very good instrument where you again look at comparative, saying if you are able to create a mechanism through which at a low cost you are able to produce a high value thing, your unit economics looks much different than anybody else. You have a negotiating factor available out there. And I'm saying negotiating because this is where, when there is no direct data to justify a reasonably aspirational valuation, you need to look at all of these factors to create a story. Similarly, the team credibility. If you have got really the hardcore subject matter experts, which are not very easy for a typical startup to get from the market, if they are on your team, they are sitting onto that, or the founders have that kind of credibility, they are repeat startups, or they have their track records. Some of these things they becomes very critical factor for demanding a particular valuation, because you are now also putting a value to really the team coming in as an asset. And similarly, if you have got any kind of supply chain structures, licenses, any other resources you have created, any kind of deals you already have, which may not necessarily be converting at this point of time into revenue, but they are ensuring that you have an unfair advantage in the market in terms of differentiability. That is again another factor you can use for the valuation part of that, right? So you look at this direct and indirect depending upon the stage you are in. You need to be able to leverage something like this to be able to create a good justification for you. This is the reason I believe that my valuation company need to be at this stage. Again, I'll take a quick pause here because we may not have too much time left later on for too much questions. So let me take a pause and see if there is any question for the topics or the particular thing that I already have covered.
We have a few questions in the pipeline, and we also have 2 hands raised. I'll just give them permission to speak.
Please.
So my questions are normally VCs, they take a multiple of just the revenue, current revenue. Let's say we have a revenue of 2 crore, they'll take a multiple of 5 or 10 max at the max. But in overseas condition, when you talk of a foreign investor, then they take multiple factors like IP, your market reach, your total market size, etc.
Yep.
But why in India, even for deep tech startups, they take only multiple of revenue?
So I don't know that I can really comment on really why they do that part. But what I can tell you, I support you in terms of your observation. It does happen. Some of these things are much easier in outside in foreign investors. The way they look at it, the entire scheme of things, even getting multiples actually. Not every business, not every sector will have the advantage where they are going to just land up this multiple and give it to you. It is going to vary a lot where you have B2C versus B2B versus B2G, IP driven versus pure transaction driven. Depending upon the nature of your business, they will not. But I think most important factor to me take away from this kind of condition is what my observation says. As founders, often we are not ourselves convinced enough and done enough homework to be able to, for example, IP, if you take, I will tell you out of 10, 9 founders I'll find if I'm asking them to put a value to IP, they don't know how to put that value to IP. So if you're just simply going to go to investor and say, look, I have an IP, you need to value me more, they are not going to do anything with you because they know that you don't understand, you don't know. And they themselves don't know what is the value of IP you can put in because they have not gone into detail of your IP to know everything, to know that whether it is $1 million IP or it is a $10 million IP, right? So this is what is onus on to you as a founder. Look at this way. When you are going on a negotiation table, if you are not tabling these things, not negotiating, then you are not getting that thing at all. If you negotiate, at least there is a 50% chances that some of these things is going to get you better valuation than otherwise you are looking purely the revenue multiples. So my suggestion would be, look, you can't change too much in terms of the psyche or the behavior or the mindset which investor will have. What we have. We have to deal with it. But it is our responsibility when you have so many different leverages available, do your homework, create your calculation, take help. You may require help from experts who are there who can do this calculation and help you do that part. And when you're sitting across the table, you very respectfully, humbly, you can tell them, look, I do not agree with this valuation. And reason we think that valuation has to be better because of look at where we stand. And each factor, for example, if you're talking about unit economics, you are not just simply telling them that this is what my unit economics is, you give me better, but you're telling why it is better than what you will find with other similar companies. We have done something special to be able to create this kind of a unit economics, and that's why you will get better profitability, faster profitability, and a better defensibility. So these arguments need to be properly tabled. Now, there, if you table it, my sense is what I've seen, if you are able to with the knowledge and with the expertise of this doing homework, you do that, you have 60% plus chances of that you will be able to get better negotiation than simply looking at the revenue multiples. Another question do we have?
Please. Thank you, Rakesh. Thank you so much for this. One of the questions that I have is about the technology IP. How do you actually do a valuation based on your technology? Because in a deep tech startup, one of the key differentiator is the technology that you bring to the table. Now, what is, because obviously the Indian investors may not be privy to some of these technologies that like the like the US investors could potentially be privy to. So
Right.
that makes it a lot more challenging. Second is, what is the methodology that we would need to follow for this technology IP valuation? Is there some template or some sort of a guidance that you can potentially look at it in this perspective?
Sure, and I fully relate to. I mean, I have been fortunately my all my experiences largely is into deep tech and technology, and this is the first challenge actually when we started. When I started looking into the startup, it was with the deep tech because it is very difficult even 15 years back for having a deep tech startups being valued or being looked at as a very interesting thing by investors those times. Today, though, you have a lot more. But in terms of the IP valuation per se, see, there are actually formal exercises, formal methods where the IP can be valued, but that cost money. When you're going for a, let's say, Series A, Series B, those kind of, and at that stage, if you have a significant IP not just being simply calling, saying, okay, I got one. Of course, patents and those are there. Those also can be valued based upon really the kind of defensibility they might have. But there is a proper IP valuation exercise which legally can be done. If it is what is the contention where you believe almost 30% of your valuation is all because of IP. And I've seen, I'm telling it based upon the experience where some of the deals where it is entirely an IP oriented investment because they know the IP which has been created tomorrow, that IP alone will be highly valuable when you are taking it with it. So if you very, very seriously believe that the IP itself is very significant, you could call for actually a proper IP valuation exercise. So there are agencies who do that IP valuation. But because it costs money, and you have to also look at whether investors are really, really, I mean, if you invest that much money and whether they are going to agree, not agree, you have to take the judgment call. But if you're not going for that exercises, yes, methodically, at very minimum, think what you should look at it. When you say my IP is valued, ask the question that why that value? Where is that value? When I say value, what does it mean? So one dimension of that is saying what does it take to create this IP? So if I were to build a particular algorithms and to have a certain level of accuracy, so give an example, one of the startups where for them to train an AI model, the amount of exercises that have to be done uh, on the ground with the manual work, everything, that itself costed upwards of $3 million. So saying just anybody, and this is not specific to this startup. We are saying if this kind of exercise have to be done to create this kind of an IP, it takes this much time, this manpower, this kind of assets, all of that, that itself require you just the expense alone is $3 million. And then on top of that, I need to have experts, which are really deep expert. They have put in 10,000 hours into that thing. If you look at from a foreign equivalent perspective, if you were to have the consultant coming in, what value they come in typically. So just look at it, what it takes to basically get that IP created. That gives you a good idea in terms of what is it, the value of the IP creation alone. And then on top of that, what you can look at it, if you have that IP, that IP, is it allowing you to capture a segment or capture a business which without that IP, it's extremely difficult anybody has to get it. So this is what is defining your how much lead you have in the market before. So if it is going to take 3 years for anybody to create that kind of an IP, that IP does not exist today. So this creation is one cost, but amount of business that you're saying if I have this IP, I'm able to do roughly this kind of business as a part of this thing in the lead. That is the extra differentiation that I've made. So if I'm doing, let's say, $10 million business from that IP I'm creating, that is what is the gain that I have because of this IP, which others don't have as part of that. So some of these things, even though these are not, I would say, official or formal, whatever, but this is what mechanism minimum you can take a look at it depending upon. Often these investors are very open to hear your arguments. See, they're not sitting out there. If you have got a good deal in terms of the solution, in terms of market, everything, they will give you a fair chance. They'll listen to you fairly. If you are able to present your arguments in a sensible way and with a very structured what a homework you have done it, they will give a consideration. After that, it is a negotiation. So you can make a call. You want to spend money, actually get the IP valuation done. If it is a really IP-centric company, tomorrow you may, even the companies you want, if let's say tomorrow there is a sale happening, even that would call for actually formal IP evaluation. So that you could go for. Or otherwise, you create a structure like this. Unfortunately, I mean, I can't get into too much of detail in terms of those whole IP methodologies, valuation thing. But yes, that can be done. I'll take one more question.
Sir,
Yeah,
namaskar.
Rakesh, Ganga here.
Yes, Ganga.
We just crossed 4 o'clock, and any thoughts on how you would want to take your slides, because there are some questions as well. So, and I just wanted to kind of get a heads up. So, are there some critical points you want to cover through your slides, before jumping into the question? So, and then, wind up.
Yes, I thank you, Ganga. Thank you for keeping that check. I'll probably take maybe one or two questions and then I'll move on to slide, and then I'll cover in next round all the slides.
Yeah. So Nirupam, can we extend it by a few minutes more, the session?
Yeah, sure. There's no problem in extending.
Okay, fine. So, okay, Rakesh, back to you. We'll
you.
try and close it as quickly as
Yeah.
possible, and so that the content and questions are
Sure.
suitably answered.
Sure.
सर नमस्कार, मैं भुवनेश शर्मा बात कर रहा हूँ.
बताइए शर्मा जी.
Sir, how to globally structure the company to increase the valuation? If we are in India, we wanted to grow globally. We started a company in America. We wanted to be in Europe as well. तो अभी इसको स्ट्रक्चर कैसे करें जिससे कि जो मेन कंपनी है, जो इंडियन कंपनी है, उसकी वैल्यू जो है वो बढ़ जाए. Every company cannot be connected to the Indian company. There are a lot of regulations and other things as well. So, what is your recommendation in this? कि how to increase the valuation in terms of the foreign companies? So, sister concern नहीं खोल सकते हैं कई जगह. नाइजीरिया में नहीं खोल सकते हैं, अफ्रीका में नहीं खोल सकते हैं. बहुत मतलब मल्टीपल इश्यूज हैं लीगल. तो how do you suggest कि how to increase the main company valuation, या मेन कंपनी को R&D कंपनी रखा जाए और बाकी कंपनियां सेल्स कंपनी बनाई जाए? मतलब what do you suggest, sir? I really don't know.
See, this we will need to look at very specific to really what is, because structures could be very different, and I mean we haven't seen really from a structural perspective the valuation thing, but in general, from investor, I will talk more in perspective of investor. So if you have a master company, the main company, main concern, and then you got the sister concerns wherever, investors will always put money into your main company. They are not really, very few happens. What more happens that you will have people putting money into the sister concerns at a joint venture. They typically don't go for investment into, often, I mean, exceptions are always there, but mostly investors would want to put money into the main company. So if you are looking at your prima facie, the lot that you think will be excited putting money into your company is going to be sitting outside India, or you believe the investor outside India is far better investors in terms of various different factors that work for you, it's better to have basically your main company headquarters outside. Because from outside, I mean, cases that where they put in money into the Indian companies are less likely to happen because of various, not only regulatory issues, but also because of the geopolitical scenarios. It's challenging. It's a bit challenging. But if you are looking at an Indian investor ecosystem from where your money, primarily the first initial rounds are there that you're coming here, then you keep your Indian company only as the main. If the sister concern is not connected with your company, then because if it is not connected legally, then that business, whichever way you're creating, that cannot be accounted into your main company's profile. And that is not likely to contribute to your valuation. In fact, that is more likely to create a challenge for you. But some of these things, I mean, I want to be a bit careful because they're very, very specific to scenarios, company structure. There may be other issues. So some of these things we could probably maybe take offline, and let me see if something can be done. So I'll proceed quickly because I know somehow in my mind I was looking 4:30, and apology for that. But let me quickly some of the slides I will cover which I believe are important. So I'll skip things which may not be. This will be any get shared, so you can take a look at that. But let me run through this. This is okay. Yeah. So this is an important aspect. Very quickly, I'll cover that. So if you are, look at it, what are the funding options? Typically, people will look at various stages. If you are in a very early stage, At this stage, basically money will mostly be either your own money, friends, family. You can get grants, government incubators. Usually angel investors and VCs will not be looking at that stage at all. And moreover, now we've been into 15, 20 years into startup ecosystem. Idea stage, really funding, the concept does not exist in terms of the angels or whatever. If you are at MVP or pilot at this stage, mostly either it's going to be angels or it is going to be accelerator grant kind of who will support you, because your money requirement may not be huge. And at this stage, the risk is very high. One thing that we always need to keep in mind, investors, we talked about risk, we talked about the proof. Investors don't want to put their money for you to build your product. That is not their most exciting thing. For them, what is exciting is that you have created the machinery to generate money, to generate revenue. They want to put in money to start running that machinery. To build a machinery, they expect that you need to figure out your way to build a machinery. Now, having said that, there are mechanisms which could be basically government grants are there, BIRA kind of grants, especially in the biotech. Similarly, in the deep tech, some of them government has started now coming up. Maybe you will see some of those money being available. But general from a mindset perspective, investors would want their money to create value and not being used just as a burning that money as an expense to just run the company or to just simply develop the product. And that's the reason you will see that thing. That's the reason this mapping, what you see here, if you have early traction, this is time when can go to opens up more for the seed funds, alumni networks, micro VCs. Some of them will be interested in actually funding there. Only when you come to the pre-Series A and Series A level, this is where the early stage VCs, venture debt, or the VCs who are going to basically look into that. So if you are in a very early stage and you keep sending your decks to VCs, it is not going to help you because VCs are not looking at the fund. So you need to be aware that the kind of VCs or the kind of financing group I'm talking about, do they look at it this stage of a startup or not? If they don't, do not send your decks and do not unnecessarily try to basically get into that, because that is going to take time and it is going to waste your time as part of that thing. So this awareness is very important. In terms of investor interest per se, and because this is one of the questions which are there in early stage, really, what is it that investors are looking at? How do they judge? So purely I'm looking at comparison, look at early stage and Series A. At the level of early stage, people are talking about vision and potential. That's what they are judging. Hello?
Yeah, sorry. Please continue, Rakesh.
At a Series A level, it is more about really evidence graph and the category leadership. That's what their investors are looking at. So in the early stage, what are the deciding factor? Very big important factor is the team, the founders. Because this is what they are betting upon. The huge value in terms of really the founder profile, the credibility, everything, the market, how differentiated are you, what you are doing it, and how can you defend what you are doing in terms of the business. So these are all at a more of a potential level. So these are the key things they are going to look at it. And typical metrics, what you can, depending upon what stage you are able to present number of pilot customers, field trials, solution performance data, if you can share that, any kind of MOUs, LOIs, or any kind of strategic leverages, contracts, any kind of licenses, those kind of things that you have got, which is giving a confidence, they will look at that, and your IP. So these are things typically what at early stage, which investors are going to look at that. While when you Series A, of course, it becomes, this is very representative set. Its list is much longer, but usually they'll look at your annual recurring revenues, your growth, your customer acquisition growth, how it is there, product usage pattern. They'll look at your sales pipeline, conversion rate, all of these things. Because what they are really looking at is your growth engines. That are you ready to because if I'm going to see one thing, I think even as a parting thought for when you finish off this presentation is we need to remember, if somebody is putting in money at an early stage, how are they going to get their returns? If you are at early stage, it's very less likely that very soon, very quickly, you are going to get into IPO. That is not going to happen. So some of them in a very early stage might be interested to put through right up to the IPO, whatever, if the in-between investors who are coming there allowing them. If they are okay with that, then they may be interested. But otherwise, the mechanism through which they will look at it, your funding rounds. So it is not just about what you are pitching yourself for getting funded now, but you also need to have the viewpoint that how after this funding, will I be going to be ready for my next funding round based upon what I'm able to do. So if you are able to convince them that even the next round, what I'm going to create out of these things, it is going to be not that difficult, it's not going to be that challenging, that becomes a convincing factor. So you have to keep in mind the current round as well as what is it? Because when the next round happened, this is when next or the one after that is when the exit may be possible for the very earliest stage investors at that point of time. So for them, even if everything is good now, but for them to see that the future rounds will happen or not plays a very important role for them to take a look at that. So I think I know that there are certain questions out there, so I will stop here. And I think some of the slides are there, which I think will get shared and you will get a good idea. And post that thing, if there are any clarifications needed, whatever, I'll be available on email to be able to help you people out. And I'll pause here. If there are any question, I will prefer to take a question at this stage.